I'm Michael Smith.
I'm Chuck Osborne.
And welcome to the Iron Capital Podcast,
where we break down investment stuff with anecdotes and stories that non-financial geeks can understand.
Hey, this is Michael.
And this is Chuck.
It's Wednesday, September 13th. This is the 5th episode of the Iron Capital Podcast.
Woo!
Let's get to it, Chuck. What's on your mind?
Jimmy Buffett. Jimmy Buffett is on my mind.
It's timely.
It is timely. Very sad. We lost him just last weekend. Mm-hmm. But yeah, he was on my mind, and I'm been traveling a lot, as you know, and I tend to read. That's when I do most of my reading, and so I am reading a book called The 12 Rules by Jordan Peterson, and there's a couple quotes that came in that made me think of Jimmy and how he lived his life, and how so many times we talk about how investment lessons are often life lessons, you know. So. So the thing that struck me, I was reading this book again, and one of the 12 rules that Peterson talks about is don't disturb kids while they're skateboarding. And so he tells this story about these kids that were skateboarding out in front of his university where he was a professor, and the powers to be came out and basically put all these obstacles in their way so that they could no longer skateboard because they're worried about safety and liability. Yeah. And he had this great quote that I thought was fantastic. He says, they weren't trying to be safe. They were trying to become competent. And it's competence that makes people as safe as they can truly be. He then goes on and talks about, it reminded him of an example several years ago, and I remember when this happened around here, where everyone got really worried about the liability of school playgrounds, and they started taking all of the equipment off the school playgrounds. And then he's going by one of these schools where they've taken all of the fun stuff out of the playground. And what does he see? But some of the boys have figured out a way to actually climb up on the school building or are playing on the roof. and his point was that humans, including children, because that's all, you know, they're just small humans. We don't actually try to avoid risk. They seek to optimize it. And I just thought that was a great lesson. I think that's kind of how Jimmy Buffett led his life, and we talk a lot about that in investing as well.
No, that's very true. And you know, a lot of people don't know about Jimmy Buffett's connection to Warren Buffett.
That's right, the Buffett cousins. Yeah, that's right. They referred to themselves as cousins. I don't think they really
weren't
were,
really
but,
cousins.
But yes, Jimmy Buffett. He probably did live a lot of the stories that were in his songs, but he was not the character that is in his songs. Jimmy Buffett was no bum sitting on a beach drowning his liver in tequila. He was a businessman, a very shrewd businessman. He was an investor in Berkshire Hathaway
with Buffett,
with the other Buffett.
Played at the Berkshire annual meetings.
Yeah, absolutely, absolutely. And he was a self-professed workaholic, and now he loved what he did, but yeah, he. I think the thing he had in common with his songs was that he lived his life to the fullest. Yep. He embraced risk. He wasn't trying to avoid risk. He was trying to optimize risk.
Yeah.
And that's, a lot of what's in his songs, and it's also a lot of how he lived his life.
Yeah, well, and that's a good segue into what we're going to talk about here, which is risk in general. A lot of his music and the story he told was about, you could think of it as the risk of not living a full life or not a full lived life. You know, and in what we're doing here is thinking about investing, right?
Right.
So there's risks as we traditionally think of risk. We can talk about it, but then there's in a lot of ways there's bigger and more important risks that still are related to your investments that people probably don't spend enough time thinking about. So let's first talk about the risk as it now is traditionally defined, which is, and people worry too much about, which is volatility. Why don't we talk a little bit about volatility and maybe quick history on where the volatility and risk came from and how that became the idea of risk.
Right. So, well, that's a great point, because if you go way back, that's not how people define risk. That is not how, for example, Benjamin Graham, who was Warren Buffett's mentor, he didn't define risk in terms of volatility. He defined risk in terms of actually losing money.
Yeah, losing money.
And that's the way real people define risk. But the idea of risk being volatility largely came from Markowitz and the academic community and the idea of modern portfolio theory, which defined risk as standard deviation. And that's obviously a little, it's not even investment speak, that's statistics.
Statistical
statistics speak.
Yeah.
But the standard deviation, if you have any, series of data points that distribute some kind of pattern. So you can say in the very long term, going back to 1926, the stock market gets a return of 10%. But it doesn't do that every year. Some years it's up 20+%, some years it's down, et cetera. So the standard deviation is the standard difference or the average difference that you see on a yearly basis for that return, just as an example. And so they define that as risk, and then they go on and also define risk relatively speaking. So and they define that as beta is the industry speak that we talk about. But anyone that remembers their 8th grade geometry lesson, that is the slope of the line, is what beta is. So if you have an investment that has a beta of 1, then it should match perfectly with the market. If the market is up 2%, it should be up 2%. Mm-hmm. If the market's down 2%, it should be down 2%. It should march in lockstep with the market. If the beta is more than 1, it's going to go more than the market in both directions. And it's going to go less than the market if the beta is less than 1%, theoretically in both directions. And so that's how risk is defined in the investment world. And the big problem with using volatility from our perspective as the definition of risk is that investors in general don't get that upset about upside volatility.
No, in fact, you need upside volatility, right?
I
need
think
the price to move up.
Yes. Yes. In the 30 plus years I've been doing this, I have yet to meet a client who just goes, "We are making money way too fast.
The price is going up too much."
I really don't like this.
Yeah.
Yes. I mean, I did not mean for you to triple our investment. Yeah. No, that doesn't happen. What they get upset about is when it goes down.
Yeah. Well, the problem with volatility too is that it's not. It's a historical measure. If you were investing in a pharmaceutical company, does how much its price moved in the past have any prediction on the fact that maybe a drug did not get approved? Right?
No, absolutely. So it's historical. So that's a perfect example. You could have a pharmaceutical company that's just minting money because they've got this great drug that's out there, and you could take a look at their stock and it's just chugging along and it doesn't look volatile at all. And then one bad piece of news comes out about that drug, and the next day that volatility is going to go through the roof.
Yeah.
And so, you're looking at this in the rearview mirror. It's also on the opposite end of the spectrum. Many times, the best and safest investments occur when there's a lot of volatility, because the most opportunities in investing happen when babies get thrown out with the bathwater, when people panic and you've got all kinds of, everyone's just selling everything regardless of whether it makes sense or not. And that's when the best opportunities are created. And in retrospect, that's the safest time to invest, but it's also the most volatile time to invest. So you're right. There's all kinds of problems with trying to define risk in terms of volatility, but for better or worse, that's what the industry does.
That's what it is. But and I think now's a good segue to move into real risk. And I think it's really nice to put that in the context of, we're always told, right? The world says that stocks are riskier than bonds. This is like a general rule that everyone in the world theoretically knows, right? And that's not always true. Let's talk about what happened with bonds in 2022 and how that translates to real risk, i.e. the risk of losing money versus just the risk of price movements in something over a short period of time.
Right, and that's another great example. There's two reasons why bonds are considered safer than stocks, and part of it goes back to, again, the kind of the ABCs of investing. A stock is ownership in a company, and you are the owner, and so if the company's doing well, the owner's going to benefit. If the company's not doing well, the owner's going to suffer. There's more volatility there. Whereas a bond isn't a loan. And if a company or a government needs to borrow money, they issue a bond, and they're promising to pay the money back plus interest. So part of the reason it is considered safer is that legal promise. It's because they're actually promising we will pay you your money back if you hold the bond to maturity. The problem in reality with that is the vast majority of investors don't invest in individual bonds. They invest in bond funds. And bond funds don't generally hold bonds to maturity, nor can they.
Yeah.
And so you are going to experience the price changes in the bond just like you experience price changes in a stock. And this is the second reason why bonds are often thought of as being safer, is because they are less volatile. The price does not move as much usually as a stock. So if you look at it by those two ways, you say, well, these are more conservative investments. But here's the problem. Again, if you look at risk in a real sense, and this is the way Benjamin Graham taught his students to do it in terms of a margin of safety, bond prices work in the reverse of interest rates. Mm-hmm. So when interest rates go up, bond prices go down. When interest rates go down, bond prices go up. When we had record low interest rates, it also meant we had record high prices on bonds. Mm-hmm. No asset is safe when you're paying record high prices.
Yeah.
And the people that poured into bonds thinking that they were safe, when interest rates eventually did go up, which they finally did in 22, what happened was, at the worst, they were down about 13%. The bond market as a whole, as judged by the aggregate index, was down about 13%. Now, that doesn't sound as bad as the stock market, because we also at the same time had a bear market, and the bear market was down at the bottom of about 26%. But here's the difference between stocks and bonds. Stocks will bounce back. Stocks have largely bounced back. They haven't gotten all the way back, but we've gotten a good bit back already. Historically, vast majority of the time, they're back within 3 years. They're almost always back within 5 years. That's what has happened in the past. For a bond investor to get back that 13% that they lost last year, it's going to take a long time, because bonds may be more attractive now that you're getting paid a 4% yield on a 10-year treasury versus a 2% historically, or I say historically, the last 15 years or so. But it's still 4%. It's not going to bounce back. It takes several years of clipping 4% coupons to get back your 13%, and then you haven't actually gained anything.
Yeah, you just gotten back.
All you've done is gotten back.
Yeah.
So,
and I think you got to put the bond loss in perspective, right? Like a 28% stock market loss is very painful, but it's normal. Like this happens every 5-6 years. We're used to that. It's a painful thing, but it happens. Bonds being down 13%, so that the index that we look at, the Barclays Ag now, goes back to 1974. It's the worst in that time period. 9.4 was the worst year prior to that since 74. There's other bond proxies that the 20s that it looks like maybe in the 26 or 27 were down that bad. But still the point is, you've never had a worse bond market.
Yeah, that's an historic.
It's a historic
event, a moment. It's a once in a lifetime moment. And like I said, I mean, it's by far the worst that they've seen in the history of the current index, the way it's structured.
And you can think more. The safest of bonds is treasuries, right? From the government. A 30-year treasury was down 30% in the year.
Right.
So it's
yeah, and that is how bonds work.
Yep.
So the farther you are out on the what we refer to as the yield curve. So which is our industry is great at making everything sound complicated and sound magical and something, how do you understand the yield curve? All that means is, again, bonds are loans, and there's different kinds of loans. So you can borrow money on a credit card, which you pay back monthly. Hopefully you pay it back every single month, and then you don't even have to pay interest or anything on it, and it's a great tool to use for cash flow purposes. Obviously, if you hold a balance, that's not very wise from a financial planning standpoint. But still, hopefully, you're going to pay that back very quickly. You can borrow money to buy a car, which historically has been anywhere from a 3 to 5 year loan. Now, because car prices have gone up, people are borrowing for longer in order to keep their payment down. But that's let's just say a 5-year loan. Or you can buy a house, and you borrow money to buy a house. Most people get the 30-year mortgage, so you've borrowed that money for 30 years. Well, the government's the same way. They borrow money for different terms, and we tend to key on the 10-year Treasury for multiple reasons. But right, they borrow money very short term, 1 day, overnight, 90 days. You can borrow money for 30 years.
Yep.
And that is what the yield curve is. That's all the yield curve is. It's just you take all those loans and you put them out by maturity and say, what is the price of all of these?
Yeah. What's the interest rate you would get?
Right, exactly.
All these different time periods.
And so and the farther you are out on that curve, the bigger price movement you're going to see. And if you think about that, it just makes sense, because if you have a home mortgage, for example, which you bought or got a few years ago, you're probably somewhere between 3 to 4% on your mortgage if you have good credit, depending where you live in the country. Also, but so if you're paying between 3 and 4%, and you're going to be paying that for 30 years. And now interest rates are almost twice that. That mortgage has lost a lot of value for the bank that's holding it, because they're still locked in to that 3 to 4% yield for that full 30-year period. That's a lot of years of collecting less than market
than you could get in the market
return.
Right now.
Right.
Yep.
And so, whereas if you had only loaned the money for 2 years,
it's not that long.
So what?
You're getting your money back in 2 years, so you can reinvest.
Right. And you can reinvest pretty quickly.
Yep.
You're only missing out on the interest payments for 2 years. So
So that's a breakdown. So obviously, we start with volatility, short-term price movements. We start talking about real risk of actually losing money, and bonds are a good example. Let's talk about other kind of really important risks that people don't talk about. Like, one is the risk of being too conservative.
Absolutely. One of the things, and we should know this by now, it's very interesting, just recently on the news, Gavin Newsom, the governor of California, came out and I think he's one of the first people that had a really strict lockdown who came out and just admitted to being wrong.
Yeah.
And good for him for doing that, because it was wrong, and that's the kind of thing where we're so focused on one thing. We're only focused on COVID and this pandemic, and we're hyper focused on it, and we want to stay safe. And so how do we stay safe? We hide in our houses. Well, that is, again, trying to avoid risk as opposed to optimizing risk.
Yeah.
And what got lost, and we forgot that there's a risk to just staying hidden in your house.
There's other risks.
There are other risks.
Long-term risks.
And we most notably, with our children who, are lagging behind educationally, as well as emotionally and socially, because of all of that. But we're communal beings. I mean, so there are risks to staying locked up, and we didn't really, in many cases, think that through. And people do the same thing with investing. You think about in a 401k investor, for example, most 401ks will have what's called a stable value fund, or if they don't, they'll have a money market or some kind of guaranteed option where you're not going to see any volatility.
Yeah, volatility goes to zero.
There's zero volatility. You're never going to see a negative return, and people think of that as being safe.
Yeah.
But they're ignoring a much greater risk, and the risk of them actually not getting the return that they need to actually pay for their retirement, and they're going to run out of money.
Yeah.
And that is an enormous risk that may be less obvious to them, but it's out there. And so, and that's what happens when you try to avoid risk versus optimizing risk, as Peterson said.
Yeah, and again, it's confusing volatility with real risk in a lot of ways. A lot of these things we're going to talk about are going to be dealing with those issues.
Right.
It's confusing short-term price movements with the real risk of what is the point of investing. It's actually there's some sort of a goal in mind that you're trying to hit.
Right, and volatility is simply what we make of it. And this goes to that's why I loved his original quote about they're not trying to be safe. They're trying to become competent.
Yeah.
Now he's talking about skateboarding. They're trying to become good skateboarders.
Mm-hmm.
But the same thing is true in investing. And handling volatility is where the competence comes in. And you're far better off if you become a competent investor than trying to hide away from volatility.
Yeah.
And we see this, in our world, including, for example, how people will sell things like private equity.
Yeah, alternatives of different types.
Yeah.
Alternatives.
Yeah.
As if there's an alternative in investing, right?
Right.
But private equity specifically is a really great example to talk about.
Yeah, and so this goes back, and we've been heavily influenced by David Swenson, who was the longtime chief investment officer for Yale University. He unfortunately
endowment.
Yeah, for the endowment. Yeah, he passed away a handful of years ago, but he's just absolute legend in our business. And he wrote a great book called Pioneering Portfolio Management.
Yeah, we should link to that. Pioneering Portfolio Management is a great book.
Yeah. Pioneering Portfolio Management is the name of the book. It is a little heady for the layperson, but if you're in the business or if you're really serious about investing, it's
a good one.
It's a great read. But one of the things he became famous for at Yale was his use of so-called alternative investments, including private equity. And there's a couple things that people always miss about that. First was this really came to light in kind of the early 2000s. This is when interest rates really started to become historically low. And what they often miss is that he didn't actually replace, for the most part, his equity exposure or his stock exposure with alternatives. He replaced his fixed income exposure. with alternatives because interest rates were so low and bonds were so expensive.
Yeah, and interest rates low for him were a big deal because?
Well, because this is an endowment. And so the way endowments work, very much the way a retirement portfolio would work while you're in retirement, is that he's got to pay out a certain amount a year. Standard endowment kind of payout would be somewhere around 5 to 6%. I can't remember exactly.
5 was what they were doing for years at Yale.
Okay, so 5 was what they were doing at Yale. I didn't recall specifically what the Yale payout was, but he's got to hit that 5% payout every single year because Yale is relying on it, and then on top of that, they want to actually grow the endowment.
He's got to grow.
So his actual needed return is going to be more around 7 or 8%, and you're not going to get a 7 or 8% return if you got a big chunk of your money in bonds at a 2% interest rate.
Yeah,
I mean, just
even if
the math doesn't work.
Even at 5.
Right, the math doesn't work, and so that is, that is the first thing that people miss about what he did, is that he was not replacing the equity, he was replacing the fixed income portion of the portfolio with most of the alternatives, especially hedge fund strategies. Mm-hmm. Now, as far as the private equity, and he made a big deal about this, and which is, and everyone should. So private equity is really no different than public equity. It's stock in a company. It just happens to be a company that isn't publicly traded on one of the stock exchanges. All right. So what makes owning a company that isn't publicly traded any different than owning a company that is publicly traded? Well, the only real difference from the investor's standpoint is liquidity. All right. So if you own stock in a public company that trades on a stock exchange, every business day that the stock exchange is open between 9:30 a.m. and 4 p.m. Eastern time in New York, you can buy or sell that stock and get rid of it. If you own stock in a private company, you can't do that.
Yeah, you can't.
Right.
You don't have a price.
Right. You have to find another buyer who's willing to buy the stock from you.
Yep.
In terms of private equity. So, so what happens with private equity, because they're not, unlike public equity, we don't know what that other buyer would buy that stock for. At any given time, because there isn't a market.
There's no market.
No one's telling you precisely that at
your Google
that right
at 130 is worth whatever price it is.
Whatever price it is.
Yeah.
And what that means is that when the economy goes down, whatever, there's some kind of panic, the market goes down. You see that in the public company. You do not see that in the private company.
Yep.
But not seeing it
didn't mean that it's not happening.
Doesn't mean it's not there.
Yeah.
And that's the thing that a lot of investors miss with private equity. Yeah. And frankly, a lot of our colleagues,
what's happened is, so Swensons invested for a multi-billion-dollar endowment. And they invested with the best private equity managers, and the money stayed with those managers for at least 10 years. They couldn't pull it for 10 years. That's the liquidity.
Right.
And so, after they sold it for 10 years, they made good returns, and partially because they have this liquidity premium because they couldn't go liquidity.
Right.
But now that has moved, and he didn't, he invested because he thought those were good long-term return streams. Now that's moved downstream to individual investors. So people that are advised by RIAs like us, more and more of those are pushing people into private equity investment. Now, why are they pushing people into private equity investment? And part of that is the reason because of the fact that they don't price daily.
They are claiming that it's safer.
Yeah, so a private
Right.
equity often is full of technology companies. So in 2022, you have people that have these slugs of private equity. These are early stage technology companies whose valuations are through the roof if you were really valuing them, right? And if you had to actually value them and they were publicly traded, their prices would have probably been down 80 to 90% at the worst of the market in 2022. But individuals who had that on their statement didn't see those price movements. And they are told that those didn't happen, right? That
Right.
even though their investments really did go down. If you had tried to sell them, you would have had to have taken an 80 to 90%
If
hit.
you had sold them, you would have taken an 80-90% hit. And you're right. So there's two parts to Swenson, and Swenson makes a big deal of this in his book. First of all, because Yale has a huge endowment, as you said, you're talking about billions of dollars. He had access to anyone and everyone, and so he could get the cream,
The greatest
right,
private equity investors.
the best of the best. The second thing is they had a lot of leverage in terms of price, and Swenson goes on and on about how he did not pay the normal fee structure of a private equity limited partnership, and that's how they're all structured arrangement. So it didn't pay anywhere close to that.
Yeah.
And historically, there's an idea in investing, and I learned this in college, and every investor learned it, that supposedly private equity should get you a higher rate of return because you are sacrificing the liquidity. Today, it certainly does not look like that is the case. It has not been the case recently. It is not the case with most private equity managers. It is certainly not the case when you start factoring in fees.
Yeah.
And what happens is you have a lot of people who keep claiming that, well, these things are safe because, look,
The price doesn't move when the market goes down.
The price doesn't move until we go out and actually try to find someone to sell this to.
Yeah.
And then, oh my gosh, we can't sell it for what we thought we could sell it for.
Yep.
And so, that's it. And we're not the only ones that have talked about this. Warren Buffett, the other Buffett cousin, has referred to it as being fraudulent, which I think is a little strong.
Yeah.
But he didn't. He's an old man, so he can say what he wants. Other people have come out and made comments about how the way these things are being sold is not accurate, and I do think there should be a distinction here because when people say that private equity is somehow safer than public equity, that is a lie. There's no other word for it.
That is untrue.
Is a lie. But there's a difference between saying a lie or repeating a lie and being a liar. I think there are a lot of people who are pushing these things who, quite frankly, just don't understand what they're pushing. And they are simply repeating the lie that has been told to them. That doesn't necessarily mean that they're lying, but it's just simply not true. Now, I will say this: because the money's locked up and you're not able to panic, contractually, a lot of investors may end up getting a better experience in private equity, but that's because of their behavior.
Because they can't sell.
Because they couldn't panic
They
and
couldn't
sell
sell
at the wrong time. That allows them to make more money. I mean, that's how people often talk about their houses being great investments. Houses are a horrible investment, especially if you really truly factor in the cost, the years of property tax, all the maintenance, all the different, small little renovations that you've done over the years. If you add up all those costs, people do not make money on a house very frequently. And especially if it's your home that you live in for a period of time. But people think they do because the price that they sell it at years after they bought it is higher. And in a lot of cases, that may actually be one of their better investments because
They can't sell.
they can't sell, and no one is knocking
Easily.
on. Right. And when real estate prices go down, there's nobody buzzing their phone every couple minutes going, the price of your house is falling, the price of your house is falling, the price of your house is falling. You don't see that, and you don't get on your phone at 9:30 in the morning and see that your house value is down, and then just watch it continue to go down all day until 4 o'clock, and then have people get on the news to talk about how your house is worth a lot less than it was. And all of this thing that provides the fear that causes people to do things that are less than wise.
Yeah. Well, I'm going to, real quick, I just want to say this and then we'll move on to the next. Private equity and alternatives. If you are even an extremely wealthy person, our experience has been, if you invest in alternatives as an individual, you're going to invest in lower quality, subpar managers that aren't as good as the greatest. You're going to pay too high fees.
Yeah.
Long-term returns will be lower than if you had just been in public markets. However, you experience less volatility, and that's what you're sold on.
Yep.
So they're just generally not great. So we can move to something else. But I think that's the short, down and dirty on alternatives for even very rich individuals.
Oh, absolutely. No, you're absolutely right. And we have seen situations where you have people where when you actually start to unravel those fee arrangements, they're paying as much as 9% fee.
Yeah, it's wild.
And you can't
overcome that.
That's not something that can be overcome.
No,
the long-term expected return, like we said, from the stock market is 10%. From private equity, if there's an illiquidity premium, you might be talking about 12%.
Yeah, and if you're getting the top quartile managers.
Right. And so you end up paying fees that are as high as 9%, and
you have no volatility and no returns.
That's not going to happen. And you're going to continue to lose money because, again, you think you found something that is somehow
magic,
safer or magic or what have you. And then someone calls the fire department.
Yeah, that's the alternatives.
So there is that.
All around
right.
All right.
It's always fun to record live.
Yeah, exactly. Yeah. All right, so we're getting close to the end. A couple other things. One of the biggest risks, period, that people don't think about is not taking advantage of your 401k match. Talk about that, and we can do that quickly, but just explain that real quick.
Yeah, absolutely. And, we talk to all different kinds of investors. I think we're unique in that respect because we have some very sophisticated institutional clients that are large plan sponsors. And for many of them, we then sit down and talk to all their employees. So we talk to a lot of normal blue-collar employees. And you'll have, I have run into this individual more than once. The very shrewd fixed interest rate investor who doesn't take any risk and always just invest in guaranteed CDs or at a bank or the stable value fund in their plan, and they'll come up like in a 401k presentation and goes, well, what's your rate? Because I can go down to my credit union and get 4%, 5%, whatever the number is. I can get that at the credit union. What are you doing in your stable value fund in the retirement plan? And first of all, as we've mentioned already, putting all your money in those kinds of investments is an enormous mistake. You're taking on a huge risk of not having enough money when you retire because you're just not going to get an adequate return. But here's the thing they're missing. If you're not at least taking the money that your employer is matching, okay, the average match is about 50 cents on the dollar for most employers, and it will vary depending on the employer. But for that amount, let's just say as an example, you can put 6% into the plan and get 50 cents for a dollar for every percent you put in the plan. That's a 50% return
That's a 50% return for doing nothing.
For doing nothing before you even put it anywhere.
Yeah.
All right. So you just put $1 in the plan. Your employer just gave you an extra 50 cents, and for every dollar you put in the plan, you got $1.50 actually in your account.
Yeah.
Before you've done anything. And that doesn't even, and we're not even talking about the tax savings.
No, all we're
Right.
talking about is
Because
dollar for dollar.
Right, because that dollar that you put in the plan, you know, depending on what your withholdings are, cost you anywhere from 75 to 80 cents for most average people. Because that's the tax savings that you're getting. And so for 75 or 80 cents out of your pocket, you're putting $1.50 into your retirement account.
There's no better investment.
The credit union ain't going to match that.
No one's matching that investment.
Right. Yeah. They're not doing that for you.
Yeah.
And so that is, but we've seen it. I mean, I can tell you
I get it all the time.
multiple times that we have run across that person
Yeah.
who just, they're not going to invest in anything but whatever the fixed investment is.
They're pretty confident.
And they're very confident about it. And and they got a guy that can, it's usually a credit union.
Yeah, it's always great. So, all right, and then the last thing, we talked a decent about this last time on episode 4, but obviously a huge thing to watch out for fraud, and I think we can do that pretty quick, right? The one thing we really talked about last time was one of the biggest ways to cut down the chance of investment fraud is simply have your money custodied or held by someone different who advises you on your money.
Right.
That cuts down on huge amount of the potential for investment fraud.
Yeah, but it's also it's if it sounds too good to be
and
true,
just generally,
it is.
Anything that sounds too good to be true, there's nothing for free.
It is.
There's nothing that's going to be given to you for
Right.
free in any, but especially in the competitive world of investing.
I'm always amazed because we we pride ourselves with trying to be extremely honest and candid with people.
Mm-hmm.
And the hardest thing that we do in our job is to convince a new prospect to actually become a client.
Mm-hmm.
And it absolutely amazes me how these fraudsters are able to get people to so easily separate from their money.
If you promise someone the moon,
but anyway, it is yes. If it sounds too good to be true, it is. There is no return in investing or in life without taking a risk, and the key is, you need to, just like you need to live your life to the fullest. I mean, if you look at a guy like Jimmy Buffett, and he died tragically too young. He was only in his 70s, which is not old in today's standards, but he lived a full.
he lived his life to the fullest.
And he left a legacy that will be remembered for a long, long time, especially for anyone who spends any time on boats or near a beach. Or
That's right.
You're going to hear a Buffett song.
Yep.
He very famously always said he was just an adequate guitar player and he didn't have a very good voice. And I actually think that was part of his magic, because the average person can sing a Jimmy Buffett song and they don't sound that bad.
That sounds pretty good. It's not like when you try to sing "I Will Always Love You" by Whitney Houston. That's some high notes.
Yeah. You don't.
That doesn't hold up.
You can't do that with Whitney Houston. Right. You're not gonna do that. Not even in the shower when you're alone. So that is not. Whitney Houston's not going to work, but you've got to actually you've got to take risk. And when it comes to investing, it's not about avoiding the risk. We talk about being risk averse versus risk avoidant. What that oftentimes means is that you've got to be competent.
Yeah.
It gets back to what Peterson said. We're not trying to be safe. We're trying to become competent. We want to be competent investors who make prudent decisions and optimize the risks that we take. Don't sit there and avoid risk.
It's not just minimize.
Right.
Yeah.
Yeah.
All right. Well, you want to leave them with something?
Yeah. Well, I mean, and one of the things, anytime you take a risk, and like in life or anything else, you can always think about like, what is really the worst case scenario? What's the worst thing that can happen to us? And I think you just got to remember what Jimmy said. Come Monday, it'll be all right.
That's exactly right. All right, on that note, leave us any comments, please, and tell us if there's anything you'd like us to talk about specifically. We're always needing new material to talk about, so we'd love to hear from you.
Thanks.
Right, thanks.
Iron Capital Advisors is an independent registered investment advisory firm headquartered in Atlanta with clients nationwide. Learn more about us at ironcapitaladvisors.com. The Iron Capital podcast is produced by Iron Capital Advisors. Our awesome original theme music was written and performed by Michael Smith and Leah Calvert. This content is for educational purposes only and should not be relied upon for investment decisions or advice. Clients and employees of Iron Capital may maintain positions in the securities discussed. Please like and subscribe to the Iron Capital podcast on YouTube and wherever you listen to podcasts. Thanks for joining us. We'll be back with another episode soon.